stream that we have on Microsoft Stream. And okay, that's it now recording. So this week, what we're going to have a look at is we're going to move into the second part of the unit and looking more at some of the narrative questions that will come up in the exam. So there hasn't been any pre-recorded lectures for this because it's very much would be me reading out what's on the slides. So it is very much a question of the slides being the starting point, you reading the chapter in the book and looking at things that I've posted onto the iLearn site for you. So this week, we're looking in a little bit more detail at market efficiency. And market efficiency is something that we introduced last year when we looked at corporate finance. And it's a measure of how efficient markets are at being correctly pricing the units that are held on that market. And on the iLearn site, as well as the lecture notes, which come from David Hillier's textbook, there are also some tutorial questions, which we'll have a look at this afternoon. And there are a number of short videos or videos for you to watch as well on efficient markets, on research that's been carried out in to see whether markets truly are efficient or inefficient. And there's also the David Hillier podcast on there, a couple of David Hillier podcasts for you to watch. So rather than me recording a lecture, you have the notes, you have the chapters in the textbook, and I'll augment that with lots of other people talking about some of these issues. And as we progress towards the exam will be in the same format as last year. So there are two sections, section A and section B. We've covered all of the input for section A, and that will be the numerical part of the exam. And in section B will be the more narrative part of the exam, which will be looking at the topics that we have left to do, which is market efficiency. We've got property portfolio building to look at, so real estate. We've got corporate governance.
Can you just say, so the first one, was it property, did you say?
It's property, yeah. So it's adding investments in property into your investment portfolio.
Thanks.
We then look at corporate governance, and we finish up looking at ethics and professional standards. So after today, there are only 3 more topics to look at. So the input should be finished at the beginning of May, which gives you plenty of time to work on things as we progress towards the exam. So if I just share my screen with you and we can have a run through the lecture slides, and then we'll have a look at the tutorial questions. And I've put tutorial solutions solutions to those questions onto the iLearn site. So we'll have a look through the solutions together, as it were. So it should be a relatively straightforward or relatively shorter tutorial this afternoon for the next 3 weeks. because we haven't got the same volume of numerical work to get through. So I'll just share my screen with you, and we can run through the main highlights of the slides. Okay, so hopefully you can see the slides. I've just left them as Alan, my colleague up at Abate, presented them. But it was the first part of the lecture. We should be finished by 4 o'clock at the latest, probably, Stuart. So you can go and enjoy the rest of the good weather, or get some more revision done, or whatever it is. So the lecture looked at the different types of market efficient theories that we've seen from last year. So we looked at strong, weak, and semi-strong form efficiencies, which looks at the amount of information that is factored into the markets. And what we're trying to ensure is that markets are correctly priced, and if they're correctly priced, they will be efficient. So to be correctly priced, all the items on that market, we have to know all the information and all the probabilities of things that will happen so that we can factor them into the price. So we'll look at the different types of efficiencies, and then the chapter looks at how behavioral finance can impact onto the decisions that we make. So just to skip through some of the slides, this is one that you should remember from last year. We had 3 forms of market efficiency. We have weak form efficiency, where it's based on past prices. We have semi-strong form efficiency, where it's based on all public information and public knowledge being factored into the price of our shares. And then we have strong form efficiency, where all information, both public and private, is factored in. And when we're talking about market efficiency, okay, really what we're saying is that if a market is efficient, then the prices of the items on that market will fully reflect all of the information available. So if it's strong form efficiency, it's all the information that's available publicly and privately is factored into the price of the shares. There was then quite a lot of empirical data to try and justify the theoretical approach to market efficiency. And as you can imagine, there's been quite a lot of research done on this from an empirical, numerical point of view, trying to prove market efficiency theories. It then talks about behavioural challenges to market efficiency. And really, I suppose the question is, are all investors rational? Okay. And rationality and people making rational decisions as investors is one of the sort of the key conditions for market efficiency. And if investors don't act rationally, then it's very difficult for market efficiency to hold because it's relying on that rational decision-making approach. So people like Warren Buffett, who one of the videos I put up, you may have heard of Warren Buffett, who owns a investment company called Berkshire Hathaway, and he constantly, or on many occasions, outperforms the returns of the market on his portfolios. Okay. And there's a video about Warren Buffett on the Island site. And in terms of behavioral impact on efficient markets, there's a couple of factors that have come out of this. One being conservatism with a small c. And this is where investors take too long to react to new information, and it leads to underaction in the stock returns, okay, because of the time delays. If you think from your own personal point of view about how long it takes for you to react to new information and how long that takes that to be factored into your actions, then it's the same idea on a market. Investors take too long to react to new information, and that leads to an underreaction in the share return. The other behavioral bias that we have is called representativeness. Easy for me to say. And this is where investors overweigh the importance of small samples. So they're not looking at the representative sample of the population of the market to make a judgment. And again, it leads to an overreaction in the stock returns because we're applying information that we have from a small sample of data to the whole population. So representativeness leads to an overreaction, and conservatism leads to an underreaction. So that was the main points from the lecture, from the chapter. If you do look at the iLearn site, you'll see a number of different short videos that I've put up here for you to watch. So if you've had a chance to watch some or all of them, then great. If not, you've got plenty of time to catch up with them over the next couple of weeks. Because remember, we're on holiday from next Monday for 2 weeks.
So you mean there's no class next Monday?
There's no class
right?
next week, Sheena. The next class after today is on the 18th of April. So if we have a look at the tutorial questions, and I'll just bring up the version with the solutions. Okay. Should up here. There's no point in me hiding the solutions from you. I mean, it's all the solutions are there. So the first one are the 3 types of market efficiency. So we've got weak form efficiency, which is based on past prices. We have semi-strong, where all public information is factored into prices. And then we have strong form, where all private and all public information is factored in. So the first questions are really just knowledge questions before you get into the sort of application. And the basis for market efficiency is that these arbitrage opportunities exist. And if these arbitrage, and remember, if you remember from financial markets last year, you looked at arbitrage and you probably looked at the work of George Soros and how he made money in a short position when the UK pulled out of the exchange rate mechanism in 1992. That should hopefully sound familiar to you.
Say that again, when the EU pulled out of
the ERM, the exchange rate mechanism, in 1992.
Thanks.
And George Soros took advantage of this arbitrage opportunity by predicting that the pound would decrease in value against the Deutschmark, which it did. And he made, was it $1.5 billion in a month. So arbitrage is where high wealth individuals can take opportunities of short-term differences in valuations. And if these arbitrage opportunities exist, then these high wealth individuals would take advantage of them, but they won't last long because the fact that somebody's buying them will then be factored into the price of the stock or the price of the currency. And there are a huge number of challenges to market efficiencies, including the behavioral aspects, so the representativeness. I knew I was going to get that wrong at some point. And conservatism, I got that one wrong as well. Conservatism. We've got bubbles and bursts of bubbles. There is also the fact that things on the market can be incorrectly priced. And there's been a huge number of examples of assets being incorrectly valued. And the real question then is, how large is the inefficiency? And I say the examples of the behavioral biases that we can have that can influence our investment decisions are things like representativeness, where we use a small sample to take as applying across the whole population. So we have one thing off the menu, we don't like it, so we don't like anything on that we don't like any food in that restaurant. Or we pop into one accounting lecture, we don't like it, and therefore we don't like accounting, full stop. Conservatism, on the other hand, is this idea that markets are slow to incorporate new information into them. And this delay is called conservatism. So perhaps the impact of COVID, there may be a delay in the market fully showing the full impacts of COVID back in 2020. And a good example of that, as I say, is, remember when we started, we first heard of COVID in early 2020, you know, how we didn't think it was going to impact on us in any major way, right up until the point in sort of May time when you guys were doing your HNDs. One of the things that we need to take account of with market efficiencies is symmetry or asymmetrical information. And asymmetrical information is where one party knows more than the other party about a certain thing. And for efficient markets, we need to assume that all information is equally known by everybody. So the question 6 about an investor following a director buying or selling shares in their company, what they're actually assuming is that there is asymmetry of information and the director of that company knows more about the company than is factored into the share price. So that would violate strong form market efficiency, because strong form market efficiency suggests that all information, both public and private information, is factored into the share price. We've got bubbles and crashes. Whether or not you believe in efficient markets or behavioral finance, there are bubbles, there are crashes in share prices. There's always been bubbles in markets, going back to the tulip bubble in 17th century Netherlands. And what believers in market efficiency do to explain bubbles is that they state that information changes, which causes prices to increase and then the price to decline. So they try and fit bubbles and crashes into efficient markets, because obviously in an efficient market, all the things on the market should reflect all the information. So there shouldn't really be bubbles and crashes in these. And the same with earnings surprise anomalies. So shares with positive earnings surprises tend to continue to increase in price for a number of months, okay, which sort of suggests that it's not been priced in at that point in time. So they were the sort of the knowledge questions, if you like. So just make sure you've had a read through those, link back to the chapter of the textbook, and then also have a look at the podcasts that I put up onto the Island site for you. The harder questions are a little bit more like exam questions, if you like. So the first one is asking you to explain what is meant by efficient market theory. An efficient market, simply put, is that all information is immediately priced into markets. But that doesn't mean that all markets have perfect foresight. What it means is that the probabilities and changes in the probabilities are factored into the price of an item on the market, and therefore it reflects changes in probabilities of things happening. So if we think about the recent movements of shares on, say, the FTSE 100 share market, and when you saw the price changes before Russia invaded Ukraine, because there was higher probability of something happening, therefore that had already affected the share prices on the FTSE 100. And once Russia had invaded Ukraine, there may be a little bit of conservatism where the full impact wasn't fully reflected in the share price, but the majority of the impact had already been recognized because of the increase in the probability. So we're not saying that markets can predict exactly what's going to happen. It's to do with the changes in probabilities of things happening. And one of the arguments is called the efficacy of dart throwing, which is rather than trying to use investor skill able to pick the shares or the things that you want to buy on the market, you're as well throwing a dart and seeing where it lands. And it's a bit like me picking a horse for the Grand National, or any of us probably picking a horse for a Grand National. We know very little about horse racing, so we just pick one that it's got a good name, or we just put a pin in the paper, or we just pluck a name out. Okay, it's exactly the same idea. And that argument in terms of markets is this idea that one share or one security is as good as any other. So the return on investment you get with a share in AstraZeneca would be the same as the return on investment you get on a share in Diageo. So there could be conservatism where things are too slowly factored into markets. But apart from that occasional slow response or the overreaction of the market, where we have the representativeness, okay, then strong form of efficiency hardly holds. Okay? So someone with access to inside information can make abnormal returns. And that's the concept of insider trading. Again, we talked about last week. But in this efficient market, prices should have absorbed all of the available information for every asset that's on that market. So for every company that's listed on the FTSE 100, they should all have all publicly and privately known information priced into them. And therefore, nobody should be able to constantly or consistently earn returns that are above the normal market returns. And it also implies is that you should adding a sort of security to a well-diversified portfolio doesn't particularly change your return very much. Now we'll look at this in a couple of weeks' time when we look at ethics, okay? Because there has been a number of very high-profile investors that have constantly made returns that are well above the market returns. One in particular we'll have a look at in a couple of weeks' time. It turned out that these returns, these abnormal returns, were not what the investors thought they were. It then talks about behavioral finance. And as soon as we have behavior impacting on investment decisions, then it does show that markets are inefficient. And going back to my Grand National analogy here, if there's a horse in the Grand National called David's Delight, then everybody that's called David would irrationally put money on that horse. Now, it might not be very good at jumping over fences, but that doesn't matter because we have reduced the odds for David's Delight by so many people irrationally putting money on it because we like the name. So that market would be inefficient because the behavior of the investors, the gamblers, has changed the prices of the odds so that they're incorrect. And that's an inefficient market. And if we accept that markets can be inefficient because of behavioral bias, that it opens up the idea of financial engineering to create value. And it also suggests that prices of shares may remain below net present value. That means companies could be priced incorrectly for prolonged periods of time. So behavioral bias will have an impact onto the how efficient a market is, in the same way that behavioral bias has an impact on how efficient the Grand National odds are. When the bookmakers make the odds, it will reflect form and all known information, and then we distort it as gamblers with the horses we pick. And one of the sort of the key investors that always seems to outperform the market is Warren Buffett. And there's a video of Warren Buffett with Charlie Munger discussing the performance of Berkshire Hathaway, which is an investment company. And
can you say those names again for me, please? Sorry.
It's Warren Buffett, and he's interviewed by Charlie Munger.
Thank you.
And what they're looking at is how Warren Buffett seems to constantly achieve a higher return on investment than other investors. Okay. And because he gets a higher return, it's therefore difficult to explain somebody like Warren Buffett if everything's above board. And I'm not suggesting that it isn't. And it could be down to luck, in the same way that we could fortunately pick the right horse to back in the Grand National. But more commonly, his success is explained as being an outlier, as being that one point in the data set that's far out with every other point, and it's just an anomaly. But as more people outperform the market, it does fundamentally raise the question about how efficient markets are, because the information you're using to make the investments to get a return higher than the normal market return should be factored into the price. So it raises the question, therefore, how efficient are markets? And because of his success, Warren Buffett will get preferential treatment and preferential deals when companies require refinancing and things like that. So he's brought on his own success, has generated more success for Berkshire Hathaway. And then there's a link to an article on Warren Buffett if you're not familiar with him. So that was the tutorial questions. It was the lecture, the notes, the chapter. As you can see, there's no real numerical work. So it is a question of just expanding what you're watching and what you're reading. But if I just finish up and make reference to the exam. So if you come back and look at the exam papers, you've now done the mock exam last week. So we're now on to paper 2. And paper 2 has 2 questions. Again, you do 1. So it's supposed to take you an hour to do each question. And Let me just see if I can find an example of one that has efficient market efficiency in it. Okay. So last year, market efficiency wasn't in the exam. That's not to say it won't be in the exam this year. It seems to be ethics and property that was in the exam, both in the main paper and the resit paper last year. So what to do is to have a read through the chapter of the book, have a read through the lecture notes and the tutorial answers again. If you haven't had chance to watch any of those podcasts, go back and have a look at some of those podcasts. Okay, especially the Warren Buffett ones are quite interesting. And then when we come back on the 18th of April, we'll have a look at how we can use property as part of an investment portfolio and how we can diversify our portfolios by including property. And then we'll look at, so there is lecture 7 on risk, real estate and property investment. And there is tutorial 7 and the solutions which are on the iLearn site. And the lecture looks at what commercial property is and how it differs from other types of investment. And it looks at how we can calculate yields and returns on investment and how we can use the principles of the capital asset pricing model and the concept of beta to measure risk. So it looks at how we can use that when we're looking at an investment being in property. So there will be some more numerical type calculations in that one. And we can look at capital asset pricing model, and we can look at weighted average cost of capital. So there may be a little bit more tutorial work to do next week. So that's pretty much it for this week. So I'm going to stop the recording.